zoo dollars. This is the exact number staring back at you from a cracked phone screen. You are standing in the aisle of a grocery store in Chicago at 10:14 p.m., holding a single carton of eggs that you cannot afford. The system knows one thing about you, and that is your total lack of utility to its bottom line. The machine does not ask if you are ready. It simply begins the extraction process. At 18 years old, you are positioned at the very bottom of the financial pyramid. This is what zero actually feels like. You have no credit history, no marketable skills, and no leverage to negotiate your value. Your immediate task is not to invest, because you have nothing to invest, but to generate cash flow through sheer volume of labor. You take a job delivering packages for a logistics company, working 60 hours every week. You receive a wage of $15 per hour, which feels like survival, but is actually a trap. Every 2 weeks, a direct deposit of $1,200 lands in your account, only to be immediately depleted by rent and food. The first rule at zero: you do not have a career problem, you have a volume problem. To break this cycle, you must acquire a skill that the market values but cannot easily automate. You spend 4 hours every night after your shift learning the mechanics of video editing and digital marketing. You are not seeking a degree, because a university degree takes 4 years and costs $80,000 of debt. Instead, you are looking for permissionless leverage. You send 15 cold emails every single day to growing content creators and local businesses. For the first 30 days, you receive nothing but silence. Then, a local real estate agent offers you $300 to edit a single promotional video. You work 18 hours on that single project, delivering a product that exceeds their expectations. They hire you on a monthly retainer of $1,200. Within 6 months, you sign 3 more clients at the same rate, bringing your monthly income to $4,800. Something changes, though not dramatically. Your bank account passes the milestone of $5,000. This is the competence plateau. You are no longer trading your physical presence for a minimum wage, but you are still trading your time for money. You are a service provider at this level, operating specifically as a freelance media producer. At $5,000, the bank stops charging you the $12 monthly maintenance fee because you maintain the minimum balance. This is legal, and this is normal. You realize that the bank is now lending your $5,000 to other borrowers at 8.5% interest, while paying you 0.01%. The spread is how the system compounds its own wealth using your liquidity. To climb higher, you must transition from a freelancer to an agency owner. You hire 2 editors in Eastern Europe for $15 per hour, while you focus entirely on sales and client acquisition. Your agency, which you name Apex Media, now charges $2,500 per month per client. You land 8 active clients, generating $20,000 in monthly revenue. Your profit margin is 60%, leaving you with $12,000 of personal income every month. You do not buy a new car or rent a luxury apartment, because you know that lifestyle inflation is the primary filter of the middle class. You live on $2,000 per month and save the rest in a business treasury account. By the time you turn 20 years old, your account balance reaches $50,000. The second rule: salary is a ceiling dressed up as a floor. The shift. With $50,000 in cash, you are no longer in survival mode, and the system begins to treat you differently. The bank upgrades your account status to preferred, waiving transaction fees and assigning you a dedicated relationship manager named Sarah. But you quickly discover that high-yield savings accounts paying 4.2% interest are still losing value to inflation. You need to transition from selling services to building an intellectual property asset. You launch a specialized software tool that helps real estate agents automate their video distribution. You invest $30,000 of your savings to build the first version of the software. You market the tool to your existing agency clients and their professional networks. The software charges a subscription of $99 per month. In the first 3 months, you sign up 100 users, generating $9,900 in recurring monthly revenue. Because software has a 90% profit margin, your business compounds much faster than your agency ever could. By the end of your 21st year, the software has 500 active subscribers. This is what scale actually feels like. Your monthly recurring revenue reaches $49,500. You decide to sell a 20% stake in the software company to an angel investor for $150,000. This transaction injects immediate liquidity into your personal holdings. Your net worth crosses the threshold of $250,000. The third rule: when you have no capital. Your only leverage is permissionless media and code. You are an asset accumulator at this level, operating specifically as an investor in cash flowing enterprises. At $250,000, the financial system invites you into the private wealth division. You no longer wait in line at the retail branch. Instead, you meet in private offices with mahogany desks. They offer you a line of credit secured by your software equity at an interest rate of 5.5%. You use this line of credit to acquire a minority stake in a local commercial laundry business that generates $80,000 in annual profit. This is legal, and this is normal. You are using debt to buy cash flow, which shields your income from taxes through depreciation. Your software company reaches 1,200 users, generating $118,800 in monthly recurring revenue. You receive a buyout offer from a private equity firm in Boston. They offer to acquire the entire software company for $1,800,000. After paying taxes and advisory fees, you walk away with $1,260,000 in cash. You are 24 years old when the wire transfer clears. The fourth rule, below $500,000. You are still buying assets, but above it, assets start buying each other. Something changes, though not dramatically. You are now a member of the single-digit millionaire class. The bank introduces you to a private family office that manages investments for high net worth individuals. They allocate your capital into private credit, real estate syndications, and early-stage venture funds. You invest $500,000 into a multi-family apartment complex in Dallas that pays an 8% preferred return. This single investment generates $40,000 of passive cash flow every year. You allocate another $300,000 into a treasury bill ladder yielding 5.1%. Your money is now working harder than you ever did during those 60 hours weeks at 18 years old. You realize that you no longer need to work for survival, only for expansion. You partner with a software operator to build a portfolio of micro software applications. You provide the capital of $600,000 while they manage the daily operations. Within 2 years, this portfolio generates $350,000 in annual distributions to you. Your net worth reaches $5 million by the time you turn 26 years old. The rules become flexible. The banks now compete to lend you money, offering interest rates below the prime rate. You do not explain it. You simply say it did not feel right. The fifth rule: the system does not reward complexity. It rewards asymmetric returns on concentrated risk. You realize that the entire structure of wealth is designed to accelerate those who already have momentum. But the momentum itself is built from the absolute bottom, one transaction at a time. Somewhere in this city right now, there is an 18-year-old opening a banking app for the first time. His balance is $0. He is standing in a grocery store doing the math. He does not know yet what the journey costs. He does not know what it will cost, not in dollars, but in distance. The machine opens every morning, and it takes whoever shows up. The balance is $0. It always starts there. It always will.